Around an hour before I started recording this, the financial markets went through what can only be called a total structural failure. Gold plunged 8% in just 60 minutes. Silver dropped 12%. Together, $5.9 trillion in precious metals market value disappeared in half an hour. Literally, the combined GDP of the UK and France gone in less time than it takes to order a pizza. And here's what makes this truly unreal. This wasn't just metals. Bitcoin fell by $2,700 in the same hour, liquidating $356 million in long positions. Almost $100 billion was wiped from crypto. The S&P 500 lost over $500 billion in market cap today. The NASDAQ dropped 2.5%, shedding another $760 billion. Now, before we go further, let me be crystal clear about what we're seeing. This move is historically off the charts. We're not talking normal market volatility. We're talking about a system break. Market mechanics just failed under extreme stress. Let's start with silver, because this is where things get truly strange. Silver just touched the 150-hour exponential moving average and hit a 30 RSI on the hourly chart that's oversold territory. And here's the catch. The flash crash bounced exactly off that 150-hour moving average, not near it, exactly off it. That's the third time in recent weeks that level has held as critical support. Above the 150-hour EMA, things remain strongly bullish and calm. Above the 2-month uptrend, still very bullish. Below that uptrend, the risk of a large pullback kicks in. The long-term outlook stays bullish, but it starts to feel shaky. The primary uptrend line sits around $91. We haven't broken the 150-hour EMA. We held it on a move that erased $5.9 trillion in precious metals wealth. Now, connect the dots to what's happening physically. The Shanghai silver premium is plus $25. That means buyers in China are willing to pay $25 over spot price to get physical metal. While paper prices are collapsing, physical premiums are exploding. Does that sound like a balanced market to you? It gets better. 246 silver delivery notices were issued Wednesday. Total, January. Silver deliveries have now reached 9,854 contracts. That's 49.27 million ounces. The scramble for real silver is still happening. So let's be clear. COMEX delivery demand is surging. Shanghai premiums are plus $25. And yet the paper price crashed 12% in under an hour. Let that sink in. This is the disconnect between physical reality and paper pricing laid bare. When safe haven assets like gold and the silver, what people run to, when everything else falls apart, lose trillions in minutes, that's not a sign of weak metals. It's a sign of something broken in how they're being priced. Physical demand is screaming one thing. Paper price is collapsing the other way. Make it make sense. So what actually triggered this? Crypto gives us a clue. During the crash, we saw coordinated massive dumps. Binance offloaded 40,467 Bitcoin Wintermute, 12,697. Coinbase, 15,630 entities linked to Trump insiders, 15,189 Kraken, 5,548. OKX, 7,966. Whether this was planned manipulation or just panic spreading, the result was the same. Massive instant deleveraging that ripped through Bitcoin, equities, and precious metals all at once. This wasn't gradual price discovery, it was forced liquidation at scale. That leads to the real question today as markets were in full panic mode. Is this a preview of an impending Gulf War? If war really does break out, what do you think will turn green first? I'm not here to tell you war is definitely coming, or that this crash was purely geopolitical. I don't know. Nobody does yet, but I do know that when you see coordinated selling across Bitcoin, stocks, and metals, when you see extreme events like this, with margin calls cascading, collateral evaporating, and forced selling, you're looking at a fragile system under massive stress. Here's the mid-video reveal that reframes everything. Gold down 8%, $3 trillion erased. Silver down 12%, $760 billion erased. S&P 500 down 1.2%, $780 billion erased. NASDAQ down 2.5%, another $760 billion erased. Trillions gone in an hour. Notice something. The percentage drop in precious metals was 4 to 10 times larger than in equities, but the dollar amounts wiped were roughly similar. Why? Because leverage and positioning in metals were enormous. When margin calls hit and collateral vanished, metals got hit harder percentage-wise, not because of weak fundamentals, but because paper leverage was extreme. When Shanghai is paying $25 over spot and COMEX deliveries hit 49 million ounces in January alone, you don't have a demand problem, you have a paper market problem. Now let's talk about what could go wrong, because I won't pretend it's all bullish all the time. The bearish case is real. If that 150-hour EMA breaks, the next stop is the primary uptrend around $91, another 10% down from here. If equities keep falling, if margin calls continue, metals could get dragged down further short term. Physical holders might panic, weak hands might sell, big players might buy the dip while retail freaks out. More volatility is likely in the coming days, and I'm not exaggerating. A quick risk warning: if you're trading with leverage in paper positions, options, or futures, you could get wrecked here. Margin calls don't care about your thesis. Forced liquidations don't care about fundamentals. If you're over-leveraged, a move like this can wipe you out before things turn around. That's reality. But here's the other side. The bearish case, while real short-term, doesn't change the long-term setup. Every bullish factor we've tracked for months is still in place. In fact, it's been reinforced. COMEX deliveries are still surging. Shanghai premiums are still exploding. Industrial demand from solar, EVs, data centers, 5G, and defense hasn't changed. Central banks are still buying gold. The dollar is still being debased by endless deficits. Geopolitical shifts with China hoarding and BRICS diversifying haven't changed. What changed is the paper price got crushed by forced selling. And that's happened before in 2008, in March 2020. Metals got hammered in the initial panic, then ripped higher once the crisis became clear and central banks flooded the system with liquidity. I'm not saying that's guaranteed now, but the pattern is there. The fundamentals are there. Technical support held at the 150-hour EML for now. If it keeps holding, this could be a major shakeout before the next rally. If it breaks, we need to brace for more short-term pain. So, where does that leave us? 3 key takeaways. The paper-physical disconnect just blew wide open. Shanghai's plus $25 premium and 49 million ounces of COMEX deliveries alongside crashing prices shows a broken pricing mechanism. Physical tells one story, paper tells another. Which do you trust? This wasn't normal volatility. $5.9 trillion in metals value gone in 30 minutes is beyond extreme. Multiple analysts are calling it a system break. Whether it's coordinated or just cascading margin calls, the result is the same: extreme financial fragility. Watch the 150-hour EMA. It held. If it continues to hold, the bull market stays intact. If it breaks, we could retest $91 on the primary trend, and that could get scary fast. Trade and manage risk accordingly. I don't know if this is the start of something bigger geopolitically or just a massive leverage flush, but the next few days will be critical in telling us whether this was a shakeout or the start of a larger correction. Stay sharp. Watch the technicals, watch physical premiums, watch COMEX inventories and deliveries. The truth is in the data, not in the panic. Do your own due diligence. This isn't investment advice, just observations on what happened and what it might mean. You're responsible for your own decisions and risk management, nobody else. If you don't understand the risks, if you don't have a plan, if you're over-leveraged, this environment will eat you alive. But if you've been stacking physical, if you understand the long-term thesis, if you're positioned for volatility, then this might just be noise before the next major move. Time will tell. Stay focused. Stay disciplined. Invest with logic, not hype.